Hello and welcome to BW Business World. Today we have with us Mr. Abhishek Agarwal. He is the founder of Rockstud Capital. Also, he is a seasoned investor with over 15 years of experience in Indian financial market. Hi sir.
Hello, Nitesh. Pleasure. Yeah,
So,
please go ahead.
so first of all, please elaborate your thesis for investing in early stage startups in India.
So, Nitesh, basically, Rockstud Capital has started its journey about 4.5 years ago with our first fund called Rockstud Capital Investment Fund Series 1. It
Hmm.
was a AIF Cat 2 fund, and we had made 10 investments from that same fund, which has been fully deployed now. And the thesis was always around investing at a growth stage, right? And that growth stage we have further defined as pre-series A. So just after seed and angel round
Hmm.
and much before a series A, that's where we had been investing for all this while. And that also gave us enough confidence that that is the stage where if companies are doing well,
Hmm.
funding winter doesn't come, that much because it is normally around the late stage funding. And we have been very cognizant about our own theme, which we have brought in as Yuva Bharat, which is Young Indians' Dreams. And here our focus has been largely towards the life cycle of the youth in terms of what they're going to consume in the next 7 years of India, where we will be moving from $3 trillion economy to $8 trillion economy by 2030. Largely, our theme has been around consumption, digitalization, sustainability, financial inclusion, and health and safety. So these are the broader themes we had identified where we would like to focus. And with a new fund, which is again in the AIF Cat 1, which we have recently got a license in March, now we will be investing close to 25 startups in the next 3 years across these themes.
But you have already invested in companies such as Big Heart, Everest Fleet, and Five Heads. So, what common factor drove you to invest in all these startups?
So first of all, I like to just touch upon two liners again each company because that will support the thesis. As we had suggested that we believe that India is going to grow massively from here, and the per capita consumption, which today, if you look at from the overall GDP point of view, we are close to $2,200 per capita GDP. Now at $8 trillion, we are looking this number with a 150 crore population approximately around $5,200. Now, what was happening earlier was that 80% of this per capita GDP currently was going against the roti, kapda, and makan. Okay. So, in that context, out of $2,200, $1,800 were only going in the basic necessities of anybody, and only $400 was left for additional spend, whether it is healthcare or whether it is your own safety or consumption further, financial savings, etc., etc. Now, if you look at the same number at $5,200 per capita at 2030, then we believe that the roti kapda makan, even if it gets expensive, this $1,800 will move to about $2,800, right? But then the incremental jump in terms of your available quantum which is there for you to now put in the consumption from $5,200, if you remove the $2,800, right? That's where you're getting another $2,200 now for these activities, which is a significant jump of more than 5x itself. So we had identified that is going to be a trend, and therefore when we had invested in Everest Fleet or Big Heart, where Everest Fleet back in 2019, when we invested in that company, they were having totally 150 cars with them. They were owning those cars. The driver was at their payroll on commission basis, and the entire fleet as a service was given to Uber. So if you're booking something on Uber, that is basically they were supplying the cars to Uber. Okay. Now they were only present that time there. We gave the growth capital. After that, there were series of rounds which took place. Now the best part is in this now 3.5, 4 years after today, where it stands, average fleet today on the ground has 11,000 cars present across 7 cities in India. And recently, Uber himself, itself has invested $10 million in the company last month, right? And that is because what I was saying, that the consumption theme is going to be really going to take off. And a quality supply, at a reasonable cost is what everybody is looking after, right? And therefore, if you look at, the personal spend, typically, if you had this per capita GDP available as a spend, then only you can afford to go in taxis or, airlines, etc. Because now you can have the capacity to spend. Earlier, people were very cognizant about, cab sharing or, going by public transport. So it is only a nature of, what is available in your pocket and how you're going about it. Now, that is one level of where the youth are. Second part, we also saw that as much as India has to grow, is agriculture activities also has to grow. Now, India is, of course, in the world is the second largest country where you have the land parcel for agriculture, right? And we are definitely either number one or number two in many such productions which we do on an annual basis on agri products. So unless there is some kind of technology doesn't enable the farmers, the further scale would be very low. But the problem is, despite having this land chunk, despite having a leadership position, our contribution to the world in terms of the agri products as an export is minuscule. It is less than 5%. So, therefore, in that context, we believed that what farmers need is a better accessibility to information and a quality supply chain at a reasonable time frame, which they can help themselves in terms of having the right yield to their product, putting the right things to the farm, and getting the better yield. So that's where we, saw Big Hath, where the founders had prior experience itself into this field, and they were very passionate about making their country digital first, where farmers now on their mobile phone actually can order everything, whatever they need at their destination. It's like something called Amazon of, farmers. When we had invested in this company, their monthly GMV was close to 3 crores per month. That means they were doing on an annual basis 36 crore business. Today, I'm proud to say, in a 3-year time period, this company now doing a monthly GMV of 100 crores, which means a 1200 crore business annually. And we have, of course, some large institutional investors backing this company in the last round. And right now, a lot of interest is coming from Japanese investors to actually see that where India can go in terms of this sustainable long-term growth sector. So that's where we felt, because again, the youth is going to grow from here in terms of formally coming and taking up the jobs, and the consumption typically increases in your young age, right? So all that, people who are coming, the India consumption story is not going to go down, and therefore we felt that's another way of participating in the consumption story through a Big Hath entity. Fab Heads is another very exciting portfolio company we have. The founder is IIT Madras, and also an ex-ISRO scientist. When he was there in ISRO, he identified a key problem where there are certain parts which are required by these organizations, specialized parts, which is based on strength, like, what kind of strength you have to qualify and as per the design. Now, typically such part, because, you would also imagine that not every rocket would have the same parts, and depending on the size, it would accordingly have the, materials. So we believe that, this founder had identified that, pain problem. And then he started with a 3D printer concept where the raw material was largely carbon fiber, right? So now what they're doing, they are making a specialized product as per requirement, for these kind of organizations, which helps them to achieve a timely delivery of such niche items, and B, that way you don't have competition truly. Largely, the kind of companies available right now in the market is all international and nothing in domestic. So the founder, of course, took quite a time to indeed build his technology. But I'm proud to say that today the capacity is good enough to service Tata Defense, DRDO, ISRO, and etc. So again, there are a lot of places where India can really do something great, because we have the talent in this country. It's only that the equity capital was not available earlier, and bank would never, fund these kind of ventures at a very early stage. And that's one of the biggest change I felt has been happening in this country for last 10 years. And you will continue to see a lot of niche ideas going forward. So this is where we are, and this is what how we have supported our theme with our investments.
So we can conclude that it was majorly driven by the consumption pattern in the country.
Yes, I would consider that one. But when I say consumption, we don't restrict only towards FMCG products or consumer products. When I say consumption, it mainly means the life cycle of the youth. And in that life cycle, whatever the sectors are coming in terms of the touch points, that's what we are looking at investing.
Oh, that's a very well explained. My next question would be on your second fund. Like you committed to invest in around 25 companies. So can you please share us about how many companies have been benefited from your second fund?
So we got our license only in this year by March. Now at presently we are doing a fundraising. So we have decided that first we will cover the entire fundraising exercise to be concluded by September, and then we would start investing. Our idea is every year we would like to invest between 8 to 10 startups, and over the 3 years we would like to build a portfolio of 25 companies. And for that, of course, because our first fund has done really well, and probably we are one of the few funds in the country where our return to capital to investors has been quite early. Within the fourth year, we have seen a tremendous response by the existing investors. So, and plus they are also giving us references. So we are doing a fundraising. So far, no investment has been made, only because it has been hardly 3 months since we have got this new license. And we are still, doing our fundraising exercise. And hopefully in the third quarter of this year, we would start investing again into our themes.
So you have recently launched PMS with a focus on banking like startups that are mainly based in the theme of middle class. What is the specific reason behind the same strategy? And according to you, what are the sectors poised to yield attractive ROI in the equity market?
So Nitesh, I mean, the first fund what we had done, we were one of the unique funds in the country where we were having hybrid structure,
Hmm.
which means we were investing of course, in startups and also in public listed equity markets, that is stock market. Now, when we had continued this theme for 4.5 years, we realized that typically investors prefer to invest in one particular asset class, and their allocation is quite committed towards that. So we believed that we were providing this two kind of asset class in the single fund was becoming a detrimental factor for us to scale. So then what we have decided, we wanted to use our experience and create two different buckets now for the investors to participate independently. So what we have done, we got our Cat 1 angel fund license, which was again in March, and we got PMS license again in March. Both the license actually came together. The PMS license largely means we are catering to the listed equities, and that's where the more mature companies are there, available on the public listed equity platform. There also, our theme is not different. Theme is same, right? The theme remains Yuva Bharat. And what basically we are doing there is basically identifying those mature companies which have already achieved a certain scale and proven themselves into that particular market where they can scale further on this growth trajectory. So we typically look at investing in companies where the market cap is from 5,000 crores to 25,000 crores. That's our range. And largely here we look at profitable companies. We look at companies where EBITDA margin is there, PAT margin is there, return on equity is higher than 15%, no debt, low pledge of promoters. So this is the quality check we do. And you would also know that typically in listed equity markets, once you have the theme in place and your own stock universe, then buying is relatively easier because that basket you can create because of the liquidity available in the market versus startups where you have to spend 3 to 4 months each company to build upon. So it's two different legs of the same coin. At a startup, you are looking at very early stage companies which has done a small concept which has proven, and then you will probably look at certain factors which supports the growth in those companies, and then you take that bet, which is highly risky in nature. Versus in the listed equity markets, you look at more of a liquidity and lower risk compared to this. So again, two ends of the same chain, and that's how we have been going in the market with a philosophy that investors from any age bracket can choose our products depending on their own risk profile, what they like it. So if it is, people prefer to have a long-term vision and would like to take a little risk, then they can come to startups. And people who like liquidity and look at stock markets as a place where they know that similar story can be played out and you can still make money, we provide that. But our overall fund theme remains Yuva Bharat, and that's what, we don't differentiate that theme any product wise. The products, all products shall cater to the same sectors what we are talking about.
Okay, so as far as exiting is concerned, so what is the checklist before exiting a startup? Are you planning to exit from any of your portfolio companies from Fund One?
So Nitesh, I mean, we probably are going to be. I mean, that's a moonshot. I think so. I'm thinking what we have achieved is that probably we are the first fund in the country where within the fourth year of our running of the fund, we are able to now going to return the entire capital invested in us
Hmm.
through one single exit. So we are in discussion with one of our portfolio companies where we have exits on our table, and within 4 years we are looking at a multiple of close to 20x from our invested capital. And this is very in advanced stage. I can't name the company. By that, typically any startup, whoever is a VC in the country, typically would have investment horizon of between 5 to 7 years. That's where your shareholder agreement typically makes it. And within that period, companies are expected to grow and raise follow-on round. And probably at a certain stage, exit comes through secondary. So I am happy to say that, even right now where people might be thinking that the investments have slowed down
Hmm.
or the interest has come down, on the contrary, I feel that if you have built a right portfolio and the companies have done right thing, you would find buyers, and that's true to us. And our typical exit point is beyond Series B. So once a company reaches a Series B stage, that's where we believe the demand comes very higher. And typically at that point of time, to save the cap table, the exits come through secondary by the new funds. So that's where we have experienced, and yes, that's where we are. So that's where we have a thesis that typically at that stage, after 5 years, we typically look at exits.
So my next question would be on the headwinds the whole startup ecosystem is going through. Startups have been right sizing their business in an attempt to right size their business. They are laying off. They are taking cost cutting measures. So what is your take on the same? Like layoffs is the right way of cost cutting, or you like you have some other alternatives. So you want to suggest to the startups?
See, Nitesh, I believe that, any business, whoever is building as an entrepreneur, everybody is chasing growth. But in that growth, at a certain level, one has to also see rationalization of their business. If you're continuously going to grow at a cost of burning your, company at posting losses
Hmm.
and hiring resources, which is only trying to, factor for growth, then that is not the best strategy. Okay. And because now we have seen the funding winter heading along, there's a rationalization activity which is taking place in the entire ecosystem. I would never support such kind of hire and fire approach. But when your costs are higher and then you have shareholders on your head to save your company, if you're not able to get a follow-on round, that is the reason why these companies then have no option but to cut cost. And the first cost typically they would cut is on the human resource. So unfortunately, that has been the way how these companies operate for they have been operating for the longest period of time, even in outside India. But I think so. The entrepreneurs need to be a little more cognizant about at what stage they will look at profitability, at what stage they will consider right sizing of their company, and of course have professionals involved at the right time. Most of the time, you'd also see that the founder is driving it to the last leg, and at that point of time, there can be a fallouts. It might be because of the global slowdown, or maybe because of the particular problem in the company of not supporting the right financials. So these are the things I think are the factors one should be very cognizant. It's good to grow, but the growth has to come in a right way. So yeah, this is where I probably would stand on my view.
So we have also observed startups considering raising fund at lower valuations in an attempt to survive and maintain the sustainable cash flow in the company. So, what are the key factors impacting the valuation markdown of the startups, and how they can immune themselves from these kind of headwinds?
I think there has been a wrong precedent set in the market where somebody would probably believe that every time the valuation of the company has to keep growing up.
Mm.
And nowhere in the world, in an equity class, the valuation or the market cap can be linear. So therefore, if something is going up, something also has to come down. And that's what we are thinking and seeing, that this is what is typically should be in a rational market. Second thing, it is happening because these companies are not able to support the target revenues they were looking at versus the way how they would have built it in the financial projection during the fundraise. So if you're not able to meet the numbers, then certainly the valuation won't support. Second thing is because of the high cost model, they would have by that time whatever their plan was, they would have already done with their funding, whatever they had raised in the last round. So now when they are going for the new rounds, which is they are desperate for capital, the investor at their level would evaluate and try to give them a lower valuation so that they're also having some kind of margin of safety. So this is what is happening. I think so. It is correct in nature. It is also ringing alarm to all the investors or to the founders to not to assume that it's a linear journey, and you need to be accountable to the numbers what you show. You need to be accountable towards profitability, which is very important. Maybe not at PAT level, but EBITDA level for sure. So these are the things which are important, and because these companies have failed to achieve that in a reasonable period of time, and the IPO market also has dried up on. They have no other alternative but to agree to the new investor terms, and that's what we are seeing right now in the Indian market.
Right. So my next question and the last question probably would be on the equity market. Do you foresee more headwinds than tailwinds for the equity market in this fiscal year?
Well, honestly, equity markets have really done well, surprisingly. If you look at this rally, which has started from April and till date, the market has been quite up. I think so. By index level, you are already more than 15% up, and the portfolio would be already 25% plus. That is quite a number, honestly, to be achieved within 4 years, 4 months. Now, I feel that, in India right now, the liquidity is very strong. The companies are doing well. If you track the results, you would see that they are able to post growth despite high inflationary market and also high interest rates, and that shows that there has been some sort of structural change after COVID, where the demand has been maintaining since then. So I believe that this trend can continue unless there has not further deterrent factors coming from global side, right? And again, we are looking to see elections coming along going forward, both at US and as well as India. So that is another one important factor to consider. So I think so. The markets in the next 9 to 12 months can be range bound, and they would closely monitor the situation between these two large economies of how it's going to turn around going forward. So I don't see a major correction or tailwinds, but certainly I think this rally now would take a pause, and the market shall consolidate for the new items to look at, or the new important data points. Interest rate is also not stopping. I think the Fed is also increasing rates as well as in India, and you're looking at that same effect. That is also one factor to be looked at it. So there are factors to consider, but the growth is strong, and the numbers of these companies are coming well. That's the reason why you are looking at such kind of rally. So it is supported by some sort of fundamental and not blindly. But at the same time, I think so. Time to be a little cautious and hold the horses in terms of making the right portfolio and consider the volatility is going to be the game. So if tomorrow the market corrects 10%, one should not panic because the rally also has been so one-sided. So I think the investors need to be a little more cognizant and you know feel their portfolio to be safer than just going and doing any kind of adventurous trades.
All right. Thank you. Thank you so much for the discussion, sir.